Hi guys. Today we will analyze Charles Schwab Corporation Common Stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock's overall performance in the market is below average. Also, recent evolutions are not positive. The short-term trend is negative, while the long-term trend is still neutral. Strong support levels are around $60 and $50. Next strong support levels are around $45 and $33. Strong resistance levels are around $71 and $83.50. Next strong resistance level is around $92. In the last month the stock has been trading between $59.40 and $71.70 range. It is currently trading near the lows of this range. The stock has an average volume of 8 million. This is a good sign, as it is always nice to have a liquid stock. The stock has been in a downward trend since February 2022. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Valuing financial institutions. Understanding why financial institutions are different from traditional real sector companies is key. Banks function differently than traditional cash flow-driven companies. Traditional companies create products to make money. The products of banks are money. Banks are highly levered and they do not reinvest debt in the business and instead use it to create more money. They make money via interest. So, they view debt and interest differently. That's why our favorite discounted cash flow valuation method doesn't work for banks and insurance companies. Intrinsic values calculations. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. The excess return model. This approach is used for financial institutions where free cash flow is difficult to estimate. Then, we will use valuation based on earnings per share, EPS, 5-year average PE ratio and expected growth rate. First model. Excess return model valuation. This spreadsheet contains some financial data that we will use for the stock valuation. In this valuation I will use margin of safety. 30%. Once we actually figure out what we think this stock is worth, we are only going to buy the stock if it gets 30% of what we think it's worth. It gives us a big margin of safety if our predictions are wrong. In other words, when something is worth $1, I want to pay only 70 cents for it. I want to be conservative with financial institutions. So, my margin of safety is 30%. According to our formula, the fair value of the stock is $57.97. When we apply the margin of safety to that value, the fair value of the stock would be $40.58. That's the price that I may want to pay for this stock. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for Charles Schwab is 2.76. Minimum rate of return. I will use 10%. Because when we invest in individual companies, we are looking for a higher return than the S&P 500. For Charles Schwab, analysts forecast growth rate around 12% per year in next 5 years, and future PE around 15. I will use 3 different scenarios for Charles Schwab Company: bad, average, and good. First scenario. Charles Schwab will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 6%. Future PE would be low, 15. In this case, the fair value of the stock today would be $30. Second scenario. Charles Schwab will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 8%. Future PE would be average, 17. In this case, the fair value of the stock today would be $40. Third scenario. Charles Schwab will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 10%. Future PE would be high, 19. In this case, the fair value of the stock today would be $52. As you can see, today the stock is a bit overvalued, $60, even if we expect the company's high performance in future. The profitability of Charles Schwab have multiple concerns. And the stock looks overpriced at the moment. Also, the stock has been in a downward trend since February 2022, and it can go lower before it recovers. I may consider buying the stock if the stock drops to $40. Company strengths. Charles Schwab is a leading provider of financial services, with 33.6 million active brokerage accounts, and approximately $8 trillion in client assets. The company offers wealth management, securities brokerage, banking, money management and financial advisory services to individual investors and independent investment advisors. Schwab has the largest number of active brokerage accounts in the industry. The TD Ameritrade acquisition will create synergies, used to attract new clients and assets to the Schwab platform. Following COVID and the TD acquisition, Schwab's interest-earning assets have grown tremendously, plus 104% since 2019. Fundamentals of Schwab are solid with growing accounts, assets, revenue and favorable market conditions. A rising rate environment may catalyze Schwab's largest revenue segment in the short term. Schwab remains at the forefront of many important industry trends, including business consolidation, reduced fees, and the increasing focus on lower-cost investment vehicles, including passive index funds. The company's profit margin of 30% is in line with the rest of the industry. The industry average profit margin is 23%. The company is expected to show a medium growth in revenue and earnings per share. In the coming 5 years, the revenue will grow by 12% yearly. In the coming 5 years, the EPS will grow by 12 to 15% yearly. Risks. The company is subject to risks from changing interest rates and trends in the global equity and fixed income markets. It is also subject to significant regulatory oversight, which has become more burdensome in recent years. Pricing pressure will likely be continuous in trading commissions and asset management. Integration risks stemming from the 2020 acquisition of TD Ameritrade. The company's return on assets of 0.9% is worse than the rest of the industry. The industry average return on assets is 4.7%. The company has a return on equity of 12.7%. This is below the industry average of 15.6%. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.